Well, this is messy, but it will give you an idea of what is going on. We have banks. The median credit per period for bank, which is like the typical client they are attending, and the interest rate associated with the median type they are attending. Okay, so it's like the typical client is banking attending. And we see huge difference jumping to your eyes. First of all, get this guy, Bank D. This guy, in real pesos and real interest rate, if you see the average transaction for the whole period, this guy is attending huge credit sizes at a very low interest rate. But what is going on here? Well, you have another bank, another guy. These are banks, by the way. Collection of intermediaries, if you want to see it in that way. But this bank is focusing toward a small credit size at huge interest rate. So what this table is trying to say is, hey, look, different banks, different clients, different interest rates. And what the model predicts, which is larger size credit are having low interest rate, at least is fulfilling. Interesting enough, Bank A and D are not the larger banks in Mexico. So size seems to have low effect on the efficiency in terms of the theoretical efficiency of the model. But A, B, C, and D holds 80% of the whole transactions in the market. And all banks up to H, by the way, holds 99.6% of the whole transactions in the market. Unfortunately, so far I cannot go deeper into the analysis of the branch of the bank. But at least at the bank level, it seems to be consistent that different banks are attending different clients with implications that the model will predict in terms of size and interest rate. But let's not stop here. We have more information. Yes?
Wouldn't that just be some banks specialize in low credit individuals and others specialize in high credit
Yes,
individuals?
but my model is saying why they specialize.
You have the profits of the bank.
I have the
more
profits of
efficient
the
bank should have more profits. So
well, it depends because in Mexico banks have different markets, right? This
yeah,
is
but,
just
but
one
the
market.
model says that the more efficient bank, which serves a lower interest rate, also
We will have
has
higher profits in this market. I will
Yes.
try to disentangle the profits in the market. You're right. But let us take into account that, well, financial institutions or banks in Mexico also have pension funds, also have saving accounts, also have checking accounts. So the combination of all these guys together can like distort the real profits of this market. But what I will try to do is to get the profits in this market, disentangle the profits of this market. That's a good idea. Well, if we analyze the heterogeneity of the firms who are having credit at the market, this is the number of corporate credit lines by credit size, by firm size, in 7 ranked scale. This is the information of the demand side, basically. So these guys, the one, are the low firms, low size firms. It's like $10,000 per year. Okay? What do you observe from here? Well, maybe a lot of numbers, but what I want to emphasize is this. The higher growth rate, annual growth rate, quarter to quarter, in this table is for low size firms. And this is like a consistency going down, and the firms who are increasing credit at a lower pace are the big firms. So what it seems to be from here happening is that the credit is increasing for all the firms, but it's focusing toward small size firms. So let me stop here with the evidence. And well, I have economic sector too. Which economic sector is capturing the credit? And basically is manufacturing and services, which is pretty consistent with what we expect from Mexico. Mexico is moving toward a service economy rather than a manufacturing economy. Well, what we found? We found from the data an increase in the creation of corporate credit measured by number of contracts or total portfolio. I also have the portfolio per bank and also behave more or less in the same way. As low movement of credit loan size and distribution toward relative low credit. So we have a mass in low relative credit a higher concentration of contracts on higher levels of interest rate, because the whole distribution is moving up. We have evidence of the negative relationship between credit size and interest rate, but also difference about the banks and the typical client measured by the median client in terms of credit sizes and interest rates, and the negative relationship preserves. Finally, it seems to be obvious from the data that small service firms and manufacturing firms are the ones who are having higher credit at the market. So, what we have? Well, using the theoretical expansion of the financial system, exogenous as it is right now, with a very simple framework, the model indeed predicts the observed effects of the distribution of credit size and interest rate in terms of new participants. Okay? So the model does well on that. The model also projects a negative relationship of credit size and interest rate, as the larger firms get credit from the best banks and are having a higher share of their profits or the surplus they're creating. Also, the proposed framework predicts a specialization of banks towards certain types of clients in terms of bank's efficiency, not size, but efficiency. We need to be measured so far. Also, the model explains consistently the higher concentration of credit toward low-size firms, which are the new entrants in the economy, right? Finally, what the model explains is the matching between banks or financial intermediaries and clients, but it does not provide an explanation for the extensive margin of number of contracts attained by banks, which is the number of contracts by banks, yeah?
Yeah, so I mean, it's nice to think about this as a matching model, but have you tried to do it with like the one-to-many matching models, like the job, like worker firm matching models where you have
Not
one
yet.
bank and many clients? Because that seems more like it would be amenable to this application.
Yes, I will try it. Not yet, but first of all, I wanted to push the simple model as much as possible to get insights and see what the modifications are indeed, which is, well, okay, the model seems to be consistent on some areas, but there are some opportunities of improvement. Introducing maybe some rigidities that you observe in the market that allows you to have these bunching results, for instance. Where does these rigidities come from? Maybe the cost functions in terms of searching, the capacity of endogenous separation before finishing the contract, secondary markets, which is introducing also the market for collecting resources and how collecting resources and giving resources are simultaneously determined, and asymmetric information. So this is like an extension of the basic framework. But what I wanted to prove you today is that with a very basic, simple framework, we can go a long way to explain what the observed features of the data is providing you, okay? And, well, for those of you who observed the presentation, the flyout, I found this beautiful figure, which basically has some of the content of what I presented to you today. You have a line of entrepreneurs waiting for credit. You have a bank who have the money, but only the one that matches the bank is the one who's having credit from you, right? Which is this likely relationship. In any case, any suggestions are accepted. Thank you for being here, and bon appetit.